The sweeping tax reform measures passed in 2017 were supposed to spur corporations to reinvest profits back into research and paying their own employees, and by extension, create new jobs.
We are giving them a big, beautiful Christmas present in the form of a tremendous tax cut. It'll also be tax reform, and it'll create jobs.
The $1.5 trillion plan took effect in January 2018. It lowered the corporate tax rate from 35% to 21%, and the hope was companies would use that money for capital expenditures. That includes physical equipment, offices and factories, and software or intellectual property. And that would create jobs and other employment opportunities. Many businesses did spend more on internal projects, at least initially. In the first half of 2018, business spending was at $341 billion, a 19% increase over 2017. And money spent on research and development hit $147 billion, a 14% increase. But business investment slowed later in the year as concerns about the economy grew. At the same time, companies announced buybacks to the tune of a record $1.1 trillion worth of their own stock. The stock buyback debate has drawn the ire of politicians on both sides of the aisle. In an editorial in the New York Times, Senators Chuck Schumer and Bernie Sanders pledged to introduce buyback legislation. Their bill would encourage companies to do something for workers before they could buy back stock, and pledged to set minimum requirements for investment in workers and the long-term strength of the company as a precondition for a corporation entering into a share buyback plan. At the same time, Republican Senator Marco Rubio has suggested Congress raise the rate on capital gains to discourage buybacks. The mere suggestion Congress should address buybacks drew a swift response.
This is basically legislators saying we know better how to deploy corporate capital than the managers in the business. Now, let's look to history again. Where has that led people? When government officials decide that they're the ones who can micromanage business, they're talking about exactly how much to pay people, how much benefits to give them, that they can't do share buybacks.
So what are stock buybacks? Buybacks often occur when a company's CFO thinks a stock is undervalued. When a company has excess cash, it can do one of several things: invest that money into their business by upgrading equipment or real estate, acquire another business, pay dividends directly to shareholders, or buy back its own shares. Buybacks come in different shapes and sizes, and while they can be indicative of a company's performance, that's not always the case.
Buybacks by themselves are no reason to own a stock, and in some circumstances are actually a reason to sell it. I think you never want to own a stock of a company that's wasting the money it needs to survive, or useless buybacks, or even worse, spending money it doesn't even have on an activity as fruitless as repurchasing its stock to call a bottom. And you shouldn't rely on even the largest buyback to help prop up a stock if the situation's dire.
The first and most obvious benefit is a boost in the stock's price. When a company buys back shares, it reduces the number of shares outstanding. If profitability remains the same, it will increase a company's earnings per share. Buybacks are generally taxed at the capital gains rate, while dividends are taxed as income. And if the stock is owned beyond 1 year, the cap gains rate is even lower. Buybacks can signal good cash flow. Finally, a company that has excess cash to buy back shares is generally in good shape when it comes to cash flow, which boosts investor confidence over the long term. Of the companies that initiated buybacks in the last year, these were the best performers. Critics say buybacks are a form of financial engineering that does nothing to improve business. They can also provide cover for poor financials. The artificial lift a buyback often brings can mask greater problems at a company. Companies are notoriously bad at timing the repurchase of shares. As a result, they often end up paying more for shares than they should. Legendary investor Charlie Munger sees that as one of the biggest problems with buybacks.
Generally speaking, I'm restrained in my enthusiasm for politicians telling corporations what they should do. But I will say this: when it was a very good idea for companies to buy back their stock, they didn't do very much. And when the stocks got so high priced that it's frequently a bad idea, they're doing a lot. Welcome to adult life. This is the way it is, but it's questionable at the present levels whether a lot of it is smart. Was Eddie Lambert smart to buy back so much shares of Roebuck? No. And there's a lot of that kind of mistake that's been made.
The short-term spike that stocks often get can allow insiders to profit. Most times, those insiders are executives or founders, since they are often major shareholders in their own companies. Recently, Senator Chris Van Hollen proposed barring corporate insiders from selling stock within a prescribed time after a buyback was announced. SEC Commissioner Robert Jackson Jr. recently expressed his belief that most buybacks are better for executives than shareholders. Last year, he appeared on CNBC to discuss why buyback rules should be re-examined.
After the Trump tax cuts passed, billions upon billions of dollars have been used for shareholder buybacks in large public companies across the United States. And in the speech that I gave, I showed that those buybacks are accompanied by, at the same time the company buys back shares, the executive sells into the buyback. Now, we were clear in the speech that that's not necessarily insider trading or fraud, but it is troubling. Because when an executive does a buyback, they're suggesting to the market that the stock is cheap. And the question I'm asking is, if the stock is cheap, then why is the executive selling into the buyback?
As a result, there may be new momentum within the SEC to change the rules. Jackson responded to Van Hollen's concerns with a letter. The commissioner said he found that from January 2017 through the end of 2018, insiders sell more stock right after buyback announcements. That indicated to Jackson the repurchases were more geared to executive enrichment and less to the interests of the shareholders or the benefit of the company. Another problem with buybacks is that share prices will eventually settle back to their previous levels when investors realize the company's done nothing to increase value. And finally, some investors just prefer dividends over buybacks. These were the worst performers among companies that have initiated buybacks. So what, if anything, should be done to stem the buyback tide? While many Republicans believe there's nothing to be fixed, there are several suggestions floating around Washington. One from Senator Tammy Baldwin would eliminate the 1982 regulatory change that enabled such large buybacks in the first place. Schumer and Sanders would tie buybacks to a $15 minimum wage and other improved worker benefits. And Senator Rubio would tweak the tax code to eliminate what he calls an artificial incentive for buybacks. Jackson has suggested an open comment period on rules for stock buybacks. Regardless, it appears the firestorm about stock buybacks is just beginning. Schumer's office didn't offer a specific time on when he might introduce the legislation. The bill is unlikely to make it through the Senate, though, or make it to President Trump's desk.